Good morning, everyone, and thanks for participating in this update or half-year result update for the Cardno Group. We've got a very short presentation here which has already been lodged on the ASX website, so I'm assuming most of you would have sort of flicked through it. But what we'll do is we'll try and take you relatively quickly through the presentation, and at the end we'll certainly try and answer any questions you've got. So hopefully this will be a relatively straightforward and painless process. I'd like to kick off by going to page 3 and looking at a very high level how we're going, for want of a better phrase. The way we tried to construct this presentation was really, if you only wanted to look at 2 pages in the presentation to understand what was going on, the next 2 pages should really tell you and give you enough colour about the broader business. And then if you wanted to, you could sort of dig in more deeply. So I'll just take us through this first page. And I think the takeaway point and message really is where we've kind of turned the corner on the business, and we feel that we've now got a clean business with which to work, and that we're behind the process of seeing lots of ins and outs and out of the account and having to clean up the balance sheet and having to work through the business from a perspective of not knowing what we've got. So in our mind, this is really the first clean result we've had for a number of years. I'm pleased to say that as per the guidance the board gave at the end of last financial year, we're running consistent with that, which is about 30% up on last year or prior corresponding period to 30.2, and guidance for this year we've set at 55 to 60, and at this stage our expectation is that we will hit somewhere in that range. We're not able to tell you whether it'll be at the low end or the high end, but we do think we'll be somewhere in that range. We've had very strong cash flow conversion for the first half at 105%. Peter will explain a little later. It's not as good as it looks, though. It's a very strong result. It's a little. We've had some early prepayments which have sort of made the number look stronger. As we work through the full year, we think we'll fall back to where we expect the business to be, somewhere circa around an 80% cash conversion rate on the business. That said, we've had a further clean up, or tightening probably is a better phrase rather than clean up, tightening of the balance sheet. We've seen our net debt now reduced to a negative $3.5 million, which I think is fantastic. WIP and debtor metrics are continuing to improve. So we've got a much stronger handle on the business, and I can honestly say to you, the business has adopted a very strong cash culture now, cash conversion culture. Are we getting paid? What's our debtor book looking like? Where are our creditors? How we're managing that? And I think that's permeating from the board all the way through the business, down to at a group level in terms of the finance control function, and then down into the divisional level. So there's a very strong change in culture that's sort of been pushed through the business in the last sort of 2 years around focusing on cash. The margin accretion continues in the US. It's positive to see that the result has improved, albeit more work is to be done, and I'll talk about that more on the next page. Portfolio companies are doing extremely well. Allowing them to separate away from the rest of the business in terms of the way in which they report and account and are held accountable has been a real godsend in terms of giving them the sense of autonomy as well as a sense of ability to make decisions and get on with running their businesses. And that's really come through now as we're starting to see margins improve and new business wins and a very strong sense of accountability. One of the, I suppose, the grey clouds that we've had to deal with is probably revenue in Australia. The business underlying in Australia continues to be a very good and very strong business, albeit we've had a number of major projects coming to an end. And before we see a kick up or a kick in of any new other major projects, we've seen a deterioration in margin and a fall off in profit. We don't see that situation changing in the Australian business through the second half. We think we'll hopefully have worked through that by the end of the second half and sort of as we start run rating into the first half of next year. But right now, as we sit here in February, we don't see that situation changing through to year end. Very pleased to report we have a new CEO who's been recruited. He starts on the 1st of March and he'll be based in the US. Andy Goodwin, who's joining us, is an outstanding individual. We conducted a very strong recruitment process on an international basis, looking at candidates globally, as well as in Australia, as well as the US, which are our 2 dominant markets. In Andy, we found someone that understands the Australian market extremely well through his time as CEO of SMEC. He's worked for an extensive period of time in Asia, which again, for us is very important about where we see part of our future. And he has a background and understanding of the US market as well. More importantly, he's mobile. And without even being asked, when he looked at the business, when we spent time talking to him about the business, it was absolutely clear to him that the opportunity, both in terms of our existing business and where we can grow over the next couple of years, was disproportionately weighted to the US. And he felt the best thing for him to do was, in the initial term anyway, to look to base himself in the US for the foreseeable future to really sort of move that business along on both those angles, our existing business as well as looking at new business opportunities. So he's joining from the 1st of March. He's already started getting himself ingrained in the business and getting out and about, meeting the senior management team, understanding what he's sort of signed himself up for. So I'm hopeful that he will hit the ground running pretty quickly. More importantly now, as we step back from the business and having sort of cleaned up the balance sheet and cleaned up the business, restructured into the right number of divisions, created that accountability through the business, as well as opportunity to sort of make those decisions and on behalf of the management teams. We're now really focused on how we're going to start growing the business. And with that in mind, we're really looking at that both organically and through a bolt-on acquisition strategy, with the acquisitions really not being something like where Cardno went wrong last time, where they went to try and do some quite large transactions which moved them really out of the space within which they were in. What we're focused on is acquisitions that are strategic, either from extending a product offering in an existing service stream or alternatively geographic, which will contribute to an existing service stream or business. And we're really looking at things that are going to be complementary to our underlying business rather than looking to grow for growth's sake. So what that means for us, I think, is more smaller acquisitions, which is akin to where Cardno started, rather than looking at some game-changing event. We're not looking for that game-changing event. We're really looking at how we can contribute and build on the platform that we already have. And I think from that perspective, there should also be, as a result, a different multiple that should be paid for those businesses versus looking at some sort of game-changing event. And the last bullet point on this page is, as where we stand today and what we can see in the future, you know, the board certainly is reconfirming guidance for the full year at that sort of $55 to $60 million range, which would represent sort of a 25 to 35% uplift on the prior year at an EBITDA level. Now, I might turn to page 4 and just sort of what we try to do and try and go into it in a little bit more granularity. What we try to do on page 4 is, again, just give you a snapshot pictorially about how we're thinking about the business and where we've got different parts of the business in different buckets. We had actually hoped to be reporting a stronger result than what we thought. We had really good momentum coming out of last year. However, the hurricanes that sort of hit the US really hit us around the head. We had our operations shut for a number of days in some instances, for not days but weeks, and it certainly had an impact on work and what was going on in those markets. So as a result, we've sort of managed to come within guidance, but certainly that had an impact on the US results in particular. In terms of how we think about our business, where we think we've got our business now in, I suppose, good shape, business that's moving the right direction and improving, and then another group which is still that needs to make more work on it before it transitions into one of those other two buckets. In the good shape bucket, we've got, I suppose, a number of things to highlight. Our international development business is really performing extremely strongly. The CEO, chief executive that we have in that business, or divisional manager, she's doing a great job. The group's winning a number of new contracts, and they're really focused on managing their costs. So we've seen really good margin improvement in that business overall, as well as a good pipeline of future development work that comes through. Appreciate that the margin has come down in the last half, but in terms of where we're seeing the margin move up more generally and the robustness of that margin into the future, we feel like we've got it in a good spot. Portfolio companies, again, very pleasing to see what we've got coming out of the results in this group. Very much moving back to target margins with increasing WIP and backlog. Again, very strong performance in terms of new business wins that this group the portfolio companies have come under, and we're seeing that good traction, and we can see this sort of now out on a multi-year time frame, so we're pretty happy about that. In regards to the Australian business, again, we think we've got a good business here, stable teams, very clear focus, very well led. but revenue and margin are down on a prior corresponding period. And again, as I said earlier, that's really more to do run-off of major projects and no immediate replacements that are sort of coming into that. What we've also done is, 2 years ago, about 18 months, 2 years ago, we took a major decision to invest in business development resources, something that the company hadn't done before. We took a very senior person from within the organisation that was at the time running our Victorian business, made him the head of our business development team, put additional resources around that, and we're trying to transition the business to looking at larger projects. Now, by the very nature of that, you have a bigger cost increase in the beginning as you sort of invest in that business development resource, and then at the same time, those contracts, although they're larger, they're also more lumpy. And what that means is you're out starting to hunt, I don't want to say hunt elephants, but certainly hunt larger animals. And as a result of that, it just means that it takes some time. So we've been pretty impressed and happy with how that business development team has been running and the pipeline that they're looking to create for the business. And they're really looking out beyond the next 12 months. They're really looking at the pipeline out 12 to 36 months. We're very happy with how they're going. Unfortunately, at this point in time, we haven't actually landed any of those larger contracts. But again, as I said, from what we can see, we feel pretty comfortable about the group that we've got running that space and the commitment they've got to delivering something for Cardno. In the interim, though, what it is it's a bit of an anchor and it's a drag on our performance. But certainly from the perspective of what it's building for the future, we're pretty happy with it. Last couple of points on the good bucket. The balance sheet is in extremely good space, and we're now able to take on debt to really look to fund accretive acquisitions. We're not looking to draw funds from investors or shareholders to drive our acquisition strategy in the future. We think it'll either be funded internally out of cash flow, or alternatively, we'll be putting in lines in place with our existing banks or new financial partners to enable us to look at funding that on a debt basis, as we then look to re-leverage the balance sheet on a conservative basis to allow us to look to those sort of to grow the business more aggressively than it has in the past. And then finally, as I said, cash conversion, debtor management is a real key focus for the business in the new normal. In the improving bucket, we've got the US business. There's no doubt we've made some good progress here. We've recut the business in terms of the way in which the business looks. Our teams are stable and we've got good leadership right across the US now. And now really the focus is on revenue growth and continued margin management. This is a work in progress. There's more work to be done. It's extremely good to see the progress that we've made to date, but we're still running well below where we'd like to see this business from an optimum margin perspective. And so our hope is that over the next sort of 12 to 24 months, we're going to continue to see margin accretion within this part of the business. On the WIP side, we've got our oil and gas business, which is based out of Houston. We've got really good leadership in that business, and we see where they're heading and what they're doing with the business. They're really trying to move the business more into a testing and compliance-orientated business away from where they were before, which a big chunk of their business was more of a body shop. They're making really good inroads into that. They're pitching on a number of contracts, and they're starting to build momentum. But at this stage, they've got still a ways to go. I think as the oil price continues to recover, we're seeing a heightened level of activity in the oil space versus what we saw 12 months ago and 24 months ago. And so that's good news. And I think these guys will start winning more than their fair share of new opportunities. And so we hope to see that business continue to improve and really move into that second bucket. One of the areas that is of concern to us and has been a drag on performance in the first half is Oscar. We're still winding down our business in Ecuador, and we're dealing with legacy issues around that. I think we've talked about that before, and so there's really no new news on that. No doubt the South American economies in general are struggling, and we're doing our best to complete our contractual obligations to the government-owned organisations that we're contracted to in Ecuador and bring that business unit to an end. We have to make further provisioning associated with this. The question probably on everyone's mind is this the last one? Is there more provisioning to come? But we believe, based on what we know, and we've attempted to make sure we're as fully aware as possible, that this is the last provisioning that we'll have to make in regards to this part of our business. But you never say never, but as far as we're concerned, this is about as prudent as we can get. So certainly where we are with that business is really trying to work out, complete our contractual obligations, wind down those businesses, and our hope is that over the next sort of 6 months to 9 months, our relationship in terms of those contracts will come to an end. We'll have completed and delivered what we need to deliver, and that phase or that chapter in Cardno's life will sort of be behind it. So hopefully that's given you at a very high level how we're thinking about the business and where we see the future opportunities and challenges in our business. I'll now hand over to Peter to take us through in more detail some of the financial information, and then I'll sort of finish up at the end, and then we can take any questions. Peter?
Great, thanks, Michael. So on slide 6, the half-year financial performance highlights. As Michael said, our EBITDA for the half at 30.2 million. We're very happy with as a solid result for the half. It is off lower revenue than in the past, so we're 11.5% down on fee revenue. And as Michael said, it's a combination of the challenges in the US business associated primarily with weather events and a couple of areas within divisions which are subject to normal economic vagaries, as well as the major projects in Asia Pacific. In terms of our net operating profit, we've shown the net operating profit both after tax expense and after cash tax paid. Now, the reason for that is there's a big difference. We have substantial tax assets in the United States associated with prior year losses. And so as such, as we are now profitable and profit margins are improving in the US, as Michael alluded, we are starting to see those profits come through, and of course there's no tax to pay on that as such because of the deferred tax assets. So we'll continue to show that line broken out to give stakeholders a clear view on our cash generated as such. Substantial abnormal items associated with the change, primarily with the change in the US corporate tax rate, which required us to reduce the value of our deferred tax assets, reflecting the change in the corporate tax rate down from 35 to 21%. Now, finally, that generates a net loss after tax of $21.9 million associated with the charges we reduced our deferred tax assets. Pleasingly, backlog up 6.6% year on year, but as it happens, slightly down half on half. And that reflects as you win projects, they come onto backlog, and as you burn them up, you use them. I did allude 6 months ago that we're looking at how we measure our backlog. That's something we're continuing to do. Our method for measuring and reporting backlog for this half is unchanged from prior halves. And indeed, when we do change it in the future, we'll obviously be reflecting comparatives so that stakeholders are quite clear as to what's going on there. As Michael said, our cash flow from operations somewhat flattered by a particular client prepayment that came in the last couple of days of calendar 2017. And as Michael alluded to, the cash conversion probably heading back towards around 80% of EBITDA on a go-forward basis. Turning over to slide 7, now this slide takes us from our NOPAT or operating result at a profit of 13.9 million to the loss of 21.9 on the statutory level. And as I said just before, the largest item there is, of course, the change in the US federal corporate income tax rate from 35 to 21%. Now, also on this slide are our legacy business review costs, and there's two positives and one negative there. The positives are we had provided in prior halves some litigation matter. We were able to settle that most favourably, so therefore we were over provided. We also in Nigeria had associated with the closure of our oil and gas business in Nigeria, anticipated that we would struggle to collect our debtors there. Our team has done a fantastic job, and we're able to collect considerably more than we had anticipated, and so we needed to write that back. Conversely, as Michael just stated, there are some quite specific costs that we have accrued for as we close out certain of the Kamenovska contracts, and that's the $8 million provision that's associated with Latin America, our Kamenovska business. Moving on to slide 8, our financial performance highlights. So this shows 1H18 versus the last two halves. As I said, the revenue is off versus the last two halves, and associated primarily with major projects in Australia and some hurricane impacts in both Florida and Texas. Pleasingly, margins are improved, so 1H18 at 8.7%. We do think there is some way to go, primarily in the Americas and in our portfolio businesses. The Asia-Pac business operates on good margins already. They can always be better, but it operates on good margins already. And that really reflects, as Michael said, our management are empowered under a controlled framework, and they're making good decisions. So it's really pleasing to see that margin improve. Moving through then to slide 9, which is our half-year result via our reporting segments. Pleasingly, all of them are profitable. Now, as I said earlier, we do have some ways to go. We do think there's opportunity not only for revenue growth, but also margin growth in the Americas and our portfolio companies business. But again, all of them are profitable, and you'll see our cash results improve, particularly in the Americas, as profits there have this quite substantial tax shield, which will run for some period of time. Looking at the segments in slightly greater detail on slide 10, Asia Pacific. Now, this is really a story about the major projects that Michael and I spoke to earlier, and I've just alluded to. They largely fell off through FY17, and the business development efforts that we have underway are an important investment. And while there are some major project announcements anticipated, now whether or not Cardno is successful is not the point. The point being there are some major opportunities being anticipated to be announced in this half. Even material wins for Cardno there are not anticipated to materially impact our results for FY18. So therefore, they're not materially baked into our forecast or our outlook for the second half of fiscal 18. Pleasingly, our regional offices in New South Wales, Queensland, Northern Territory and New Zealand are all really picking up the slack and performing well. So that really shows the benefit of a combination of a portfolio of big ticket items in these major projects, as well as our regional offices. In the Americas, on page 11, pleasingly, the impact of non-client-facing cost reductions are showing through in margins. And there are all sorts of things there. As we've spoken in prior halves, management layers have come out. But we've also been able to do such things as change our insurance, our employee insurance and health programs. And it's actually resulted in a situation where the quality of the offering for our employees is slightly improved, and yet the cost for the company and the cost for our employees has gone down. So again, a really pleasing result, and that plus a bunch of other cost reduction initiatives has materially improved the margin. Going forward, as we say in the fourth chevron, we do see our business in the Americas as the biggest 24 to 36-month opportunity for both revenue and margin growth. Pushing forward onto slide 12, international development. We're really pleased with the backlog growth in the Asia Pacific. The US and Europe somewhat impacted by the changing political environment, and by that we mean the award of projects is being delayed or the decision-making process is slowed. However, we are starting to see business as usual resume, particularly with the British government agency, DFID, simply back to business, and we're anticipating some large projects to be announced in the next 3 to 6 months. As Michael said earlier, pleasing result with revenues up, margins very solid. This is historically a slightly lower margin business than our other divisions within Cardno, but a very key and stable business, and very pleased with this outcome. Portfolio companies in slide 13. Now, our portfolio businesses comprise 3: our construction sciences materials testing division, our oil and gas business in the US, and our Latin American business. Construction sciences and materials testing business are benefiting from substantial project wins, such as the various packages on the Pacific Highway, the large project just to the west or northwest of Wellington in New Zealand, and some far north Queensland mining projects beginning to return, as well as disciplined management decision making. And it's been very pleasing to see that as that business has pivoted away from primarily a mining business or a mining support business to more of an infrastructure business today. and that's really positively impacted the margins that construction sciences are driving. PPI, as Michael said earlier, encouraging more to do, but encouraging leadership there, and the decision to exit their business in Nigeria is really has helped the bottom line materially. And both Michael and myself have spoken to the situation in Latin America. Onto the balance sheet on slide 14. So net debt is now a positive of 3.5 million. So said another way, our cash assets are greater than our bank debt, which is a really pleasing impact, and it continues to improve from June 16, where it was at $50 million of debt. I spoke earlier to the reduction in our deferred tax assets as a result of the change in the US tax rates, and you see that in the DTA, the deferred tax assets and our non-current assets. WIP and debtors has continued to improve. Equally, creditors has shrunk as well. So that's we're pleased with how that's progressed. And finally, importantly, all of our covenants now have substantial headroom. On to second page on balance sheet on slide 15. As I said there, you can really see the improvement on net debt from 50 million to 15 million to positive 3.5 million. Very encouraged by that. Net tangible assets has gone down. That's the decrease in the deferred tax assets. But the real takeaway from this slide for us is that we've said in the past, we believe we have one of the strongest balance sheets in our industry. Critically, it gives us considerable firepower as we think about how to position the company for future growth. Our final slide in the financial section is cash flow. Now, firstly, we've reduced our debt quite dramatically, so therefore we're paying considerably less interest. Interest costs versus 2 years ago are down 85%. Obviously a pleasing result. We did complete a small bolt-on acquisition in our construction sciences business in New South Wales. We have completed the small ongoing buyback program continues. We purchased back some 630,000 Cardno shares in the half. And we did use the opportunity from the surplus cash generated to pay down our bank draw facility. So there was a $17 million reduction in the actual gross debt by year-end. And finally, as Michael and I said, our strong cash conversion was somewhat flat, as I said, from certain prepayments from a particular government department. With that, Michael, I'll pass it back to you.
Thanks, Peter. So look, just turning to page 18, what's the outlook look like? Look, I hate saying it's a bit meat and potatoes, more of the same. Cost control, organic growth, investing in people, they run off the tongue easily, but they're harder to do, and that's still, I suppose, the main focus for the business. In addition to that, we now want to actually start looking at selective strategic bolt-on acquisitions. That is a board decision that came about a couple of months ago, where we feel ready now to sort of start thinking about growing the business. And really we've already given guidance for 18, but really our internal guidance going forward in terms of how we're thinking about the business as a board and what we're saying to the CEO and to the CFO is really, hey, look, we want to grow 10 to 15% per annum from here. Some of that's going to come organically through the business, and some of that's going to come through acquisition. And how do we use those acquisitions to complement our existing business? And so we really think that in the US we're half built. There's more opportunity there in terms of building out our product set as well as geographic critical mass in certain markets, and we see opportunities to do that. Overlaying that, there's some additional areas that we really are attracted to that we're going to go hunting in to have a look at. And then separately, we're expecting our underlying business to sort of start to grow based on not only the investment we're making in business development in Australia, but the investment we're making into the US market. And consistent with that, that's very much the reason why Andy's going to rebase himself in the US when he starts on the 1st of March. More importantly, not more importantly, but just as importantly, is the little pictures on the right-hand side of this page. We've been very big about rolling out an updated vision, purpose and values for the business. I think this is really important, and we take it all very seriously from the board all the way down through the business, at the end of the day, we're a people business. We have to give people a sense of vision, where we're going. We have to give people a sense of purpose, what we're trying to do, and we have to give people a sense of values, what type of business we want to build. And so very much we've tried to reset the business and the people within it in terms of what our expectations are and what type of a company we want to create. And so that was something that's quite important to us in the last time. So if I turn you to page 19, really not much more to add than what we've already talked about. We're in the second year of a multi-year business improvement plan. The rebasing of the business is behind us. We've reaffirmed our guidance that we gave at the full year to 55 to 60 for the 18 financial year. We think we've sort of a 24 to 36 month journey in front of us in terms of where we still want to see underlying improvement in our own business. And so we're sort of in the first year of that. We think there's still inherent opportunity within our existing platform, and then we want to start adding to it. So I think with that, I might sort of close the presentation and then move to the question stage of the call.
Thank you. If you wish to ask a question, please press *1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press *2. If you are on a speakerphone, please pick up the handset to ask your question. Your first question comes from Wasim Kursawani from Deutsche Bank. Please go ahead.
Yeah, good morning, guys, and well done on the result. I was just hoping we could get a little bit more colour on a couple of businesses, if that's all right. Maybe starting with the Australian business, just a sense for how much of that project work is still in that base over first half 18, and then maybe just a sense of activity levels across the rest of that, Asia Pac business, any areas that sort of stand out in particular, and perhaps just on those major projects that you've sort of talked about, that the major awards that you expect in this half, whether you could sort of quantify that opportunity as well, please.
Okay, so hi, Wasim, Peter here. So in terms of you had three questions. In terms of the Australian business and the project's impact on 1H, comparatively little. So the tail wagged or stopped wagging pretty much July, August. So there was a small amount into July and August, but all of those projects had materially finished by the end of FY17. In terms of activity levels generally, we've seen really strong activity in regional New South Wales, so particularly the South Coast in Wollongong, as well as ACT and New Zealand. So I'm really encouraged. In the way we look at our business, we do see New Zealand business obviously as its own sub-geography within Asia Pac South. So encouraging results there, both in Wellington and in our new office in Auckland, and with the infrastructure spend that the New Zealand government is looking to achieve over the next 5 to 10 years. We do like the outlook there. Also, far north Queensland. So we have one of our young up-and-coming leaders is running the Queensland business there, and we're having some solid results in far north Queensland and across in Darwin. Having said all of that, though, the market in Australia is mature, and it's highly competitive. So we're encouraged, but there's still plenty of work to do just to hold your own line, as it were. In terms of major projects, look, as we say in the slide, there's a series of them in Queensland, New South Wales and Asia. The nature of major projects is we are the consulting engineer for a consortium, and just like when you decide to build a house, you select your architect, you select your builder, and then behind the scenes is an engineer. So whichever builder you decide pretty much determines which engineer is chosen. So we are really pleased with the way our BD people are working on this, but we do need those projects to be announced, and we need to be successful on them. So I'd prefer not to comment specifically on them, but I think many folks are aware of the substantial infrastructure spend, particularly on the Australian East Coast that's coming up.
If I can just add to that, how to put it to you, we're not in a position to comment because we haven't won any. We're on a number of consortia which we think are well placed. We've got good partners. We're very comfortable with the bidding syndicates that we're participating in, and statistically, we should win some of them. We're not going to win all of them, and we hope we don't win, and we hope we don't come last in all of them, and hopefully it'll be somewhere in between. But today, we can't give you with any confidence any sort of guidance on that whatsoever. I think the comment that we would say is, it's been a learning curve for the business over the last couple of years getting set on these larger projects and having to think about how they work and where they're at. There's some positive signs there that we think we're well placed on some projects, but it would be too early to allude to any sort of potential or particular success. So I'm sorry, we're not trying to evade the question.
Yeah,
we
sure.
feel comfortable being able to give you any more confidence around that, other than saying statistically we should get some of them.
Sure. No, that certainly helps. And just on the Americas business, you've called out that margins are still not where you want them and considerable opportunity to improve. Can you sort of quantify that at all in terms of where you think those margins?
Yeah, look, that's a harder question to answer as well, and I'll tell you why. Ideally, we'd like to see margins in that market move to something akin to what we're getting in Australia, something in that sort of 7 to 10% range. The issue we've got is some of it's driven by critical scale and mass, and we can see that we can get to that margin better if we had, say, for instance, another $10 million of revenue or $20 million of revenue in a particular division. And the composition of the businesses is a little different to what we've got in Australia as well. So it's a little bit case by case in terms of the divisions that operate underneath the Americas. What we do see is we're sitting here saying to you at 3.5, we still think we've got legs on that. Where we can get it back to, we'll have a stronger sense over the next sort of 12 to 24 months, but we still think that there's material improvement that we can have there. But some of it, in some respects, has got to be revenue generated rather than cost generated. So the first part of what we did over the last couple of years is actually reset from a cost basis the business and understand how many, front of house people versus back of house people we had, how we'd overcomplicated the way we were delivering outcomes in the US market, how we had basically emasculated some of the decision leaders or the leaders of those businesses from making decisions and being accountable and making calls. We fixed all that up. Now we're holding them more to account. They're all relishing that they're being able to drive their businesses more. They all understand that they've got more to go. And so we've kind of reset the base. Now we really need to see some of that revenue growth come through so that it can have that multiplier effect on margin coming through the underlying business. So there's still a bit of work to do on cost, and Pete and his team are overseeing that. But certainly what we see as part of the story in the US is starting to change the revenue profile of that business as well. Pete, would you add to that, or do you agree?
No, that's well covered, Mike.
Okay, great. Just one last one from me. Just in terms of tying in the comments around acquisitions, and we haven't seen a divvy in this result either. I mean, that's sort of reasonably conservative. Just sort of wondering whether you're flagging potential for some really large sort of M&A opportunities that you might like to consider if they come along, or can you maybe just give us some sense of that? When we look at your 19 outlook sort of guidance for growth, you could sort of almost fund that from the free cash that if you were to acquire that growth entirely, you're generating a lot of free cash at the moment. So just sort of wondering what the message is.
Yeah, look, it's a good question. I think from our perspective, given we've got such a large deferred tax asset at the moment, that it's just not and we don't have a strong franking account from memory.
Correct.
Yeah, it's just not a good use of capital to be spending it on dividends. It's much better use of capital to either be doing buybacks or alternatively reinvesting in our underlying business. I think what we're not going to do is try and gold plate the existing business and go and spend a lot of money on shiny toys. Internally, what we're really thinking about is how we can use our capital to accelerate the future performance of our business. And I think in particular, as to my earlier point, we see the US as half built. And so we do see a need to sort of go back strategically and think about how we strengthen our underlying business in the US. And at the same time, in regards to the Australian or Asia-Pac market, we're very happy to be opportunistic here. Where it makes good sense and we see compelling value, we'll do something in Australia. But our focus strategically is thinking about how we build out the US. Now, when we think about that, we don't sit there and say we need a game-changing acquisition to create that. What we're really looking at is businesses that are generating between, and I'm looking at Peter in the room here, anywhere from sort of $5 to $20 million in revenue, which are going to complement what we've already got in a particular area or bring a set of skills in that we think we can leverage across more markets. And so the US is so big, what would be disruptive now is if we suddenly did an acquisition, and this may not be the case in 12 months' time, but today what would be disruptive is if we did an acquisition which had 40 offices. Like that would be sitting there going, what do we do with that? So what for us is much more useful is an operation that maybe has 4 or 5 offices, has got good traction or good share in a particular region, or alternatively may have 1 or 2 offices but has really got deep knowledge in a particular area that we think could complement our existing business. So we're looking at it much more on a strategic basis, and that the power of that is it allows all the divisions to put forward a business case for how they can grow their business rather than focusing on one in particular. So the mandate we've given in particular to the teams, and we've done it in Australia as well, is tell us how you think you can complement your existing business. We've talked about where you have opportunities within your existing business, areas that we'd like to work on, areas that we'd like to get stronger in. Fine, let's go and talk to those groups that you already know, that you may be dealing with already, that are complementing our existing business, that will allow us to sort of fit hand in glove and allow us to sort of seamlessly integrate them. Because one of the other mistakes that Cardno made in the past was it would buy things and then just leave them alone. And it would buy them and there would be typically a founder there, and the founder would do their workout period and then they'd disappear into the sunset, and then Cardno never integrated the business, and then there was a cultural issue. What we're looking about is how we can add to our existing culture, to our existing business, bring organisations into the Cardno family and really treat them and give them the support from day one, and give someone at a divisional level ownership for that as well. So I'm not sure if I've kind of answered your question, but you know, when we think about that, we're also not thinking about doing 1 or 2 a year. It could be anywhere. It could be half a dozen, or it could be 1 or 2. It's going to come down to value, fit, is it strategically on message or not. But if we don't find anything, we're not going to be stupid about it. So I think one of the things that's permeating from the board all the way down is staying on message. Stay on message. We know what we want to do. Don't get excited. Let's do this properly, and if we can, then we'll really build sustainable growth through those acquisitions. So, you know, I think at a board level, there are a lot of people around that table that have quite a lot of experience in, you know, aggregation plays or putting businesses together, the pitfalls of that, as well as the opportunities around that. And for us, I think it's all about trying to avoid the pitfalls.
Yeah, no, that makes sense. And just one follow-up, just on that 19 outlook commentary, you're presumably expecting some revenue growth within that to contribute to that sort of earnings growth. Is that, I mean...
Yeah, absolutely. But I would say let's not take it as guidance at the moment. What we're trying to allude to you all as investors and interested stakeholders is this is an aspiration internally of what we want to do. So there's, you know, we have said as a board saying there's no reason why we shouldn't be able to see 10-15% growth out of this business if we look at it on a complementary basis between a mix of, you know, some bolt-on strategic acquisitions and organic growth in the business. This is what we should be targeting as a group. That's aspirational. We'll talk more about that in time to come, about whether we're hitting our aspirations or not. But what we're trying to allude to you all is that we've got that last phase behind us. We now think we've got a base of a business to grow. We've got a foundation from which we want to work. And now where we want to see it is we really want to see some consistent performance in the business going forward. And we want to see it driven internally as well as complemented from an external perspective, as long as it's on strategy.
Great. Thank you very much.
Thank you. Once again, if you wish to ask a question, please press *1 on your telephone and wait for your name to be announced. There are no further questions at this time. I will now hand back for closing remarks.
Okay, well, thank you very much, and thank you to stakeholders and investors who've attended the call. It's been Michael Lauscher, our chairman, and Peter Barker, and we'll sign out here. Thank you very much.